Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Hi guys, and welcome to episode 1 of Equity Mates. Very excited to have you here with my equity mate buddy, Alec Renahan, or the Renegade.
Hey all.
This is a podcast where we're going to be breaking down investing to try and make it a bit more realistic and accessible for you.
We're on our investing journey, and we hope to take you along for the ride and hopefully learn some things and impart some wisdom and tell you about some of our mistakes along the way.
Great. So I guess we'll start with you then, Ren. Tell us a bit about yourself and what was your first investment?
Okay, so my investing history got off to an interesting start. I got interested in it a few years ago now when I was working and I had a bit of money saved away and wasn't quite sure what to do with it. Ended up putting my first $500 into Slater & Gordon, a law firm that has had some subsequent issues, shall we say, and has not
Tanked it.
made me any money. Yeah, has tanked it is an understatement. But look, since then I've learnt a lot. I've done better than that first investment. Really couldn't have done any worse. But yeah, look, it's something I enjoy. I find it interesting to look at companies and how they're going. Yeah, I hope I can share that interest with all you listeners out there.
Nice. Well, my first investment was when I was in year 7. It began back when I was in kindergarten, and my parents encouraged me to put away 50 cents a week into a little ComSec saving account. And then I reached $500 by the time I was in year 7, and my dad encouraged me to put it into a diversified financial company called Brickworks Investments, which I still hold today. I got them at the IPO at I think about 40 cents or thereabouts, and it still proves to be one of my most successful investments today. So, Ren, I think we should then say, what are we going to achieve with this podcast?
Why everyone out there should listen to us.
So, what's the first thing we're going to be doing?
So, basically, what we want to do is we want to make investing accessible to everyone, people who might have a bit of money tucked away and don't really know how to get into the stock market. We want to break it down for you, tell you what we know, what we've learnt, the mistakes we've made, and make it a bit more accessible for you. For the first segment we want to do is a bit of news, and every podcast we'll talk about developments that have happened both in the market, and we'll also talk about what's happened in the broader world if it has an effect on the market or on our or your investments.
And we're not professing to be experts in anything that we talk about, but this is something that we just do over a casual beer. Yeah. So I think it's a great opportunity for us to capture that. And
and if it can save you some time, if you can get a summary of the things that are reported from us rather than having to, do the research yourself, and that makes you more interested in investing, then we've done our job. So yeah, what else?
I think one of the other major things that we're going to be doing, and it's quite exciting, is interviewing a bunch of our mates, because, we're all at different stages in our investment journey. A lot of our mates are investing and have different attitudes and beliefs towards the best way of investing, and we want to capture that and track how we grow and learn about each other's investments and also our own investment strategies.
Yeah.
So that's something to look forward to.
Yeah, absolutely. And another thing that we want to do is we want to talk to you about some of the companies that we're looking at, some of the industries we're looking at. Again, we're not experts by any means, but if we can talk about how we look at companies, what we look for when we decide to put our money into a company or into shares, hopefully you can take something from that. You can definitely learn something from our mistakes, and hopefully you can learn from some of the things we've done right along the way as well.
Cool. And so I think something that is going to be of use is our hypothetical fund that we're going to start to create and track that will be available on our website, equitymates.com. So essentially each episode, each podcast, we will be adding a stock of our choice to this fund that we create using amounts of money that are accessible and realistic. We're not going to be doing $10,000 hits, $20,000 hits. We're going to be talking $500, $1,000.
So the way we envisage it is much like we invest. We have our jobs and we try and save a bit from every paycheck. And when we reach, a certain amount, $500 or $1,000, we then will buy part of a company with that. And so we kind of want to make the hypothetical fund reflect how we invest and how we think most everyday people would invest if they had the sort of knowledge and they were interested in the share market, which is save a bit from your paycheck and then put it in the market when you can.
Yeah. So looking forward to that, and that will be able to be viewed and tracked online along with a number of other segments that we're excited to bring you guys later on down the track. So I think to close the little intro of Equity Mates episode 1, we just want to highlight again that it's a podcast for everybody by a bunch of nobodies.
Yeah.
We're not, as we said, we are not claiming to have any sort of experience or expertise above that which you can probably find online or go and pay for. But we just think that there's a number of you out there who want to start investing or have heard about it but just don't know where to start. And we hope that you can take something from this to either get you going or trigger a conversation. And so we're really looking forward to getting your feedback and comments along the way.
Yeah, and I think the point is if the two of us can invest, then really anyone can invest. So whether you've been investing for years and you want another resource to follow the news and get another perspective, or you have never invested before but you're thinking about it now, if we can do it, anyone can do it. So hopefully we can help you out and give you some advice along the way.
Beautiful.
Okay, Renner, so the field of investing, I guess, is really big.
Yeah, it's huge.
And one of the problems that I faced when I first started was trying to filter my way through so much information to try and get an understanding or a basic understanding of what the best strategy is.
Yeah, and I'm sure for a lot of listeners, that's the big sort of resistance point in even getting started. That they don't know where to find information, they don't know what they should be looking at, and so they just don't even try.
Yeah, people get really scared about it.
Yeah.
But I think that, it's definitely possible through a good attitude and understanding of the basics to really get involved.
Yeah, and I think that's what we want to try and sort of start with in this podcast is what should you how should you approach investing? What's important, and what should your sort of attitude and objective be? Because if you understand that, then at least you have a filter when you're looking at all this information. You sort of know what you should be looking for, what you don't really need to worry about. And so we're going to start there.
Yeah.
And then in later podcast episodes, we'll get a bit more specific. We'll talk to you about the different sort of things you can invest in and things that we have invested in. But today, if you can leave this podcast with an understanding of the attitude that we take and that we think would be a good one for just sort of everyday partake.
So going off that, then the attitude, I guess, that we try to embody in our investing strategy is a value-based strategy, which in itself encompasses a variety of characteristics. Why is it our chosen strategy, do you think?
Well, for me, the reason that I follow that is because it makes the most sense for me. And I guess for the way that I think about value investing is you're trying to find companies that are undervalued by the share market. So you look at the price that you can buy their shares on a market, and you think of it as if you're buying a part of the company. Which you are, but you don't worry about the sort of daily fluctuations. You don't worry about trading volume. You look at the fundamentals of the business. You look at how much money they're making, whether you understand their business model, whether you think their long-term prospects are good, and then you look at the price you're going to pay. And if you think it's a good value buy, then you buy it. Yeah.
So that's probably the broadest definition of value investing, really.
Yeah.
And I think that it's important that you've made mention to separating stock market pricing from fundamentals of the business, because I know that personally it was a mistake that I made early on, was that I would get so carried away in looking at charts and thinking that, stocks are on a run, it's a great time to buy, and I didn't really have an understanding of what those prices actually meant, and I really didn't have an understanding of what the actual business did and where it was positioned in the market, which is probably more important than the price on a daily basis.
Yeah, and now don't get us wrong, there's a lot of people out there who make a lot of money speculating, who day trade and try and, pick when there's going to be a massive run and they try and profit off that. But at least for us, we take a more long-term approach. And what we want to do is when everyone is selling and prices are low, that's when the opportunity to get good value, that's where the opportunity to get good value is. And so that's when we want to buy. And then when markets are high, like they are now in America, that's when you're not going to find much value, and that's in many cases when you would sell. I guess we should take a moment to sort of talk about Warren Buffett, because we'll be mentioning him a lot during this podcast, and there's a pretty good reason for that. He is known as the world's greatest investor, or history's greatest investor, but his strategy is something that we understand, and it's very value-based. And it's probably worth talking a bit about sort of how his strategy evolved. So when he started, one of his mentors was a man called Benjamin Graham, and he was sort of the father of value investing. And what he did was purely looked at the numbers. So looked at the company's financials, looked at the tangible assets they had, and he was trying to find companies where there was such value that, even if the company was going to be liquidated today and all of the assets sold, you would still be getting more money from that liquidation than you paid for the price of the share. So absolute value. So the assets themselves are more than the money you paid. And then any profit the business makes is just a cherry on top. Yeah. And so that's how Buffett started. And in the early years of his partnership, that's what his investing partnership, that's what he looked at doing, and was quite successful. But as he grew and as more investors got in the market, it became harder and harder to find such undervalued companies. So he summed it up quite well in a little saying that he went from looking for good companies at great prices to great companies at good prices. And that's kind of what we want to talk about here, and that's the kind of attitude that we take to investing, and we think you should. Look for companies that are good value. Look for them that are cheap, that it makes sense how you're going to make money and get growth.
And you mentioned that his strategy has maintained or has consistently been value-based, but it has changed in the way he's approached that. So can you sort of give an example of how that's changed from looking at the fundamentals in terms of the value of the company to more perhaps other reasons that he can perceive value?
Yeah, big time. So, I guess some of the examples where he's made a lot of money are like Coca-Cola, American Express,
Gillette.
Yeah, Gillette. These are big sort of name brand companies that we know now. He got in on a lot of them quite early, and for these sort of big companies, or big companies now, not as big when he bought into them, it wasn't just about the financials, and it wasn't just about looking at their asset value and stuff like that, but it was also about looking at the market, looking at the potential for them to become big multinational companies. So with Coke, they have their proprietary recipe. Coke has a really streamlined business model as well, where they almost have no overhead costs, and most of their costs are passed on to third-party bottlers. So they're very streamlined. They have great cash flow, and as an investor, you have a potential to make a lot of money in a business model like that. Similarly to a company like American Express, the electronic payments market was becoming bigger and bigger when Buffett invested in them. Credit cards were becoming more of a thing, and he saw the potential there, not just because of the company's financials, but because of their future prospects to become a huge player in that market, and he picked it right. And so that's what we want to look at.
Yeah.
We're not just numbers guys. We want to sort of look to the future and see what we think is going to be bigger and has a lot of growth prospects, and things where industries will grow a lot.
I mean, the numbers side is something that I definitely want to really improve and learn a lot more about, because it's definitely a very important part of value-based approach.
Yeah.
But I think what we're basing our decisions on at the moment when we're investing is the macro side of things. So, where it's positioned in the market or where it's positioned within its industry. Is it a dominant market position? Does it have a great competitive advantage over the rest of the competition? Is it an industry that has high barriers to entry? And then also things like management, like does the company have a stable management? Does it have a CEO, CFO that's well respected in the industry? Do they have a very good record? How do they treat their shareholders? All of these things are stuff that I look at, and you would as well.
Absolutely.
When we sort of base our decisions around buying stock.
Yeah. So to give the listeners some idea of how we approach value investing, maybe do you have an example of an investment that you've made and sort of the thought process behind it and why you bought it?
Yeah, definitely. My Bellamy's is probably a company that was my first real attempt at this value-based. Up until then, I'd been doing a lot of diversified financials and ETFs and that sort of stuff. And Bellamy's was my first attempt, as I said, at looking at a broader industry and trying to sort of pick macro and consumer trends.
So for the listeners, maybe go through like what the industry is.
Sure. So Bellamy's is a provider of infant formula, and it's an Australian company based in Tasmania, and its business model is essentially a licensing business model where that they have third-party suppliers of all of the formula, and then they put their branding and their name on the formula and distribute it that way.
Okay, and why did you think it was good value?
The reason I thought it was good value, I mean, it had only been listed for a couple of years, not even, I think, only about 12 months.
Okay.
And it started to show a good run. So that got me interested in itself. At the time as well, I had been looking at the demand that they were starting to get from the rise in middle income or middle class in China.
Yeah, okay.
Because a lot of the Chinese didn't really have much confidence in the quality of their products homegrown in China.
And there was a big health scare about Chinese made in formula.
Massive health scare. The Chinese started looking abroad for much more recognized brands of infant formula.
Yeah.
Bellamy's was really well placed in the Australian market. Mm-hmm. It had a huge lead in market share. I think they still sell about 75% to Australian market. But yeah, they had a massive Australian share, a really well-respected brand, and as a result, the demand from China started to come through. So I sort of thought that was going to continue, and so I jumped on, bought them at just under $5, and for the next 2 years, thereabouts, it skyrocketed. It hit peaks of about $16. Now, unfortunately, I failed to stay on top of the company.
Yeah, well, I feel this caught everyone by surprise, though.
It did catch everyone by surprise, and there's a few people saying that they picked it, but they only, I think, are saying that in hindsight.
Hindsight's 2020.
Yeah.
So what happened? Where did it all turn bad?
Essentially, they came out with a profit guidance that then they had to readjust to the market, and then they did another readjustment of profit guidance below what was expected. Mm-hmm. So people started freaking out, looking into the company a bit more, and realised that there were a lot of sort of fundamental problems with their inventory, and that management hadn't been quite truthful with what was going on with the company. And that's a reason we say that management is a very important thing to look at. Now, it's very hard to tell that was going to happen, 6 months ago. Yeah. As we said, hindsight, very helpful to make these calls. But essentially, it's lost its value completely.
Yeah. So it's one of those things where, even so, us as individual investors, it's tough to sort of know how management's going. But even big institutions, it's tough to know, because what happened was they entered, because as you were saying there, they basically are a company that just holds the IP, and they get third-party suppliers to provide them the dairy, and they entered supply agreements that had minimum levels of supply, and demand slowed, and if Bellamy's didn't reach that minimum level of supply, then there was sort of punishments inbuilt into the contracts, and they have to pay the suppliers for not reaching that minimum
Well, it's because they've also locked in contracts.
Yeah.
Because they were forecasting that this demand was going to continue,
Yeah.
or at the time that the strong demand was there, they were scared that the supply was actually going to run out.
Yeah.
So that's why they locked themselves into this.
Yeah.
And it sort of makes me think it's my first learning about the other side of value investing. If a company is way too overvalued by the market,
Yeah.
it could be a time to get out.
Yeah, yeah. And I think that's something that we're sort of learning as we go, that just as important as buying at the right time and at the right price is also selling at the right time and at the right price. And I mean, there's always horror stories of someone who sold out and then the company went on a massive run.
Yeah.
There's all these, unrealized gains. But I think the important thing is to be quite conservative in your investing, and it's always better to sell out when you've made money and maybe leave some excess profit on the table rather than to hold it too long, like you did with Bellamy's, I did with Slater and Gordon, and all of a sudden something that you think you're feeling quite good about, you've lost a lot of money.
It's a really hard mentality to get over at the time. It's so easy to look back in hindsight and say that I could have sold or I should have sold.
Yeah,
but at the time when you've tripled, quadrupled your money, it's a lot harder to make that call because you have some sort of emotional attachment to the stock.
Yeah.
And so another thing I think in terms of what is a good investing attitude to have, one of the characteristics that feeds into value investing is managing patience.
Yeah.
Both understanding when to buy, understanding when to sell, and also understanding the long-term financial implications of being patient.
Yeah, big time.
In terms of compound interest and that sort of stuff.
Yeah.
So I would encourage our listeners that if you can start to practice being patient from the start, then you're gonna, it's gonna go a long way.
Yeah, absolutely. And there are also a few quite practical reasons in Australia to be patient when you're investing. So every time you buy or sell shares, there's a frictional cost in the brokerage. So I trade with CommSec and they charge $19.95 per trade. So every time I buy, every time I sell, the Commonwealth Bank takes $20, and so
it becomes quite expensive.
It does become quite expensive, and I mean, if you're trading in huge dollar amounts, then the brokerage.
Which we're not.
Yeah, exactly. So if you're a big institutional investor, brokerage is something that you can cop, and you can try and make monies on the daily fluctuations of the share market. I'm not a big institutional investor, and I don't want to keep paying brokerage when I don't have to.
Yeah.
And something else that is quite good in Australia, or quite good for investors, is that if you hold an asset for longer than a year, the capital gains tax is halved. So you get
That's interesting.
Yeah, so you get a 50% discount on the capital gains tax that you pay. Now, for those who are new to investing, capital gains tax, quite simply, is rather than income tax, when you hold an asset that appreciates in value, so you get a capital gain on that asset. So, you hold a share and it goes from $10 to $15. There's $5 of capital gains there. It's the same when, you buy a house and it appreciates in value. That's a capital gain because it's the value of the asset has increased rather than, you're earning income. It's taxed a little bit differently. If you hold the asset for longer than a year, you get a 50% discount in the capital gains tax. So that's a pretty good incentive to be patient, to hold it, and you can make a little bit more money that way.
Interesting. I didn't know that.
Yeah.
Well, that's good to know.
Yeah. Well, that's why you got to listen to our podcast, because we'll have great tips and tricks like that throughout.
Interesting. Okay, what else? I mean, I've learned my lessons from not being patient. I've lost money from being worried that I'm going to miss out on a price increase, and have probably jumped in at the wrong time, or probably jumped in when a run has finished and I've been trying to make a quick return, and I've bought a lot higher than I would have liked, and then that has gone on to fall in value. And if I had been patient by even a matter of weeks, it would have made a big difference.
So it may sound like we're contradicting ourselves a little. We've just told you a story about how we held Bellamy's for too long and it dropped in value, and now we're preaching patience. But I don't think we're contradicting ourselves. I think the important thing is that if you're going to invest in value stocks, what you're doing is you're betting on, well, you're looking at the company and you're saying that it is at good value now, which by implication means you're saying that the price will rise because it's such a good value investment now. Like, it's a good deal to buy part of this company now.
Yeah.
It's relatively cheap, and the price, you're betting that the price will will appreciate as the rest of the market realizes that, the strengths of the company, the potential it has, whatever it is about the company that makes it such good value.
Yeah.
But at the same time, you do have to keep informed. You have to pay attention to what's going on. And so while something like the Bellamy's incident probably was more difficult to sort of foresee coming. For me, at least, I know that the Slater and Gordon investment I made, there was a bit of writing on the wall. There was rumblings that they were sort of fudging the numbers a bit with their accounting.
Yeah.
And eventually it turned out that that was true. And ASIC, the regulator, investigated them. It turns out that they were massively overstating their profits. Not to get too much into the weeds about like the specifics of accounting for law firms, but basically there was a lot of work that they were doing, and law firms like Slater and Gordon do no win, no fee law work, and they were already adding to their revenue some of the legal work that was currently in process, where there was actually no guaranteed revenue out of it. So like there was a few more layers to it, but in essence they were fudging the numbers a bit, or they were being a bit creative with their accounting.
And the market reacted.
And if I had been more abreast of company developments, if I'd been a bit more engaged, maybe I wouldn't have lost my money. So, that, like, you've got to be patient, but you can't be patient.
You can't be laxed.
Yeah, you've got to stay engaged enough. And,
And this is with reference to buying individual stocks. Something that we'll talk about probably next episode is how you can get into the market and not have to worry about staying on top of individual companies.
Yeah. And just to give our podcast another plug, I think that's going to be a real value from our podcast is, you listen to us for half an hour once every couple of weeks, and we'll try and keep you informed, and we'll try and give you some of the information that you need.
Yeah.
And hopefully we can one day save you from the mistakes that we've made.
I think it would be good to finish on a note. One of the final attitudes or characteristics that we are currently doing that add to our whole idea of what is a good investing attitude is to make regular saving commitments so that you can also have regular buying opportunities.
Yeah.
Save something small from each paycheck. It doesn't have to be huge amounts. There's some apps out there as well that can help contribute to your saving goals or help you get to your saving goals. But there's a good saying that in investing world, don't save to save to invest.
Yeah.
Because it's better to have your money out there trying to work for you than it is sitting in a bank account at the moment with historically low interest rate returns. Yeah. So I would encourage, I know Renners and I both put regular payments into an account that allow us to then make regular purchases of stocks, or at least have some capital available so that when we see a good opportunity, we're able to jump on it.
Yeah, absolutely. And it doesn't have to be much.
No.
If even if you just, your story is a perfect example. You started investing as a kid by saving 50 cents a week. Mm-hmm. And if you can do it as a kid, then anyone can do it. Don't make a coffee make an instant coffee rather than buying a coffee. And, you've saved
$4.
Yeah, $20 a week. Yeah. So do that. Put $20 away each week, and
before you know it, you'll be in the stocks.
Yeah.
I think that's a pretty good note to finish on. I hope that we've been able to sort of encompass what we perceive as a good investing attitude is, and what are some of the good characteristics that contribute to that attitude.
Next episode, we want to get a bit more specific. We want to start talking about the different things that you can invest in, the index, and then also looking at specific stocks and sort of what we look at when we assess whether a stock is good value.
Yeah.
Yeah.
There's a number of opportunities to get into the market, which we'll go through next episode. So, guys, thanks for listening. Really excited that we've been able to get episode 1 out.
Yeah.
It's been in the making for a while. We've been pretty keen to get it going, and as they say, you'll miss 100% of the shots that you don't take.
Yeah.
It's the hardest part is starting.
Yeah.
So I'm sure we'll look back in hopefully 10 episodes time and cringe at this episode. But you know what? We're pumped that we've got it going, and we hope that you've been able to at least get an understanding of who we are, what we're about in this episode, maybe take a few things away. And until next time, just have a think about what we've said. Head to our website, equitymates.com. We'd love to hear your feedback and any comments that you have. Please hit us up. Rate our podcast as well. We'd appreciate it.
Anything you want us to talk about, any suggestions, hit us up. We're very open to ideas.
Yeah. Hopefully you'll be with us next time on episode 2 of Equity Mates.
Yeah. Thanks for listening.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.